9 words. That's all it took. 9 words from one man, in one room, in Prague. And gold moved 2.5% in a single afternoon. Silver did something even faster, because right now, there's a man sitting inside the Federal Reserve who has already done something no chairman has done in 14 years. He refused to show his hand. No dot. No forecast. No signal. Just silence. And that silence has already cost this market its worst quarter since 2013, then brought it roaring back. Within days, something is happening inside that building right now, something the retail market has not caught up to yet. And by the end of this video, you will understand exactly what it is before September arrives and moves this market again. Welcome, welcome, welcome to Stick Zennn. Now, before we go any further, I want to ask you for something, and I want you to really consider it, not just scroll past it. You know how, back in the day, when you found a good newspaper, a reliable one that actually told you the truth before everyone else caught on, you'd keep buying it every single day because you trusted it. That's what the subscribe button is here. It's not asking you for anything big, just a tap right there below this video, so that the next time we uncover something like this, before it hits the mainstream headlines, it finds you first. So if you haven't already, take a moment, hit that subscribe button now, and I'm genuinely curious, where in the world are you watching this from today? Drop your city, your country, down in the comments below. I'd love to see just how far this story is reaching. Now, let's get into it. In May of this year, a new man took the seat that controls the value of every dollar in the world. His name is Kevin Warsh, and in just a few short weeks, he has already shaken the gold and silver markets harder than almost anyone expected. Gold fell, then it jumped, then it fell again. Silver did the same thing, only faster. Investors watched the price swing back and forth, again and again, and many of them still don't understand why. This is the story of what is really happening, and why it matters to anyone who owns gold, owns silver, or is thinking about buying either one. To understand this moment, it helps to go back to the beginning. When Donald Trump first announced Kevin Warsh as his pick for Fed chairman, the market reacted instantly. Traders assumed one simple thing. They believed Warsh would be loyal to the president. They believed he would keep interest rates low and keep money flowing freely. That assumption hit the market like a shockwave. Gold dropped sharply in a single day. Silver dropped even harder, falling so fast that it became one of the worst single-day drops in more than 40 years. But that reaction, it turns out, was based on a guess. And the guess was wrong. When Kevin Warsh finally took his seat as chairman, he did something nobody expected. At his very first meeting, he refused to share his own forecast for interest rates. Every Fed chairman before him, for the last 14 years, had always given the market a hint of what was coming next. Warsh gave nothing. No number, no promise, no clue, just silence. And that silence sent a message all on its own. It told the market that the easy, predictable years were over. Then came a second surprise. Most of the other policymakers inside the Fed began leaning toward raising interest rates, not lowering them. This was the opposite of what traders had priced in back in January. The market had bet on a soft, dovish Fed. Instead, it was getting a Fed that looked tough, disciplined, even hawkish. Gold and silver both suffered because of it. Prices slid for weeks, quietly, steadily, until gold recorded its worst quarter in over a decade. Not since 2013 had the damage been this severe. But then, just as everyone assumed the tough new era was here to stay, Kevin Warsh said something different, speaking on a stage in Europe, surrounded by central bankers from other major countries. He said inflation risks had eased. Just a few words. But those few words were enough. Gold jumped within hours. Silver climbed even faster. The very market that had been punished by his silence was now being rewarded by his softer tone. This is where the real story begins. Because Kevin Warsh is not behaving like any Fed chairman before him. He's not sticking to one clear message. He's not giving the market comfort. He is keeping everyone guessing. And whether that is by accident or by design, the effect on gold and silver has been the same. Sharp moves in both directions, with very little warning for business owners, entrepreneurs, and anyone building long-term wealth. This is not just background noise. This is a signal that the rules guiding money, interest rates, and precious metals are shifting under a new kind of leadership. And in the next part of this story, we go deeper into the numbers behind this shift, the real data, the real history, and the real reason gold and silver may be reacting to something far bigger than one man's words. Numbers rarely lie, even when people do. And the numbers behind this story tell something far bigger than one man's speech in Portugal. To understand where gold and silver may be heading, It helps to step back and look at what history has already shown. Again and again, every time the Federal Reserve changes leadership, markets go through a period of confusion, but rarely has that confusion shown up so violently in precious metals. Go back to the early 1980s, when Paul Volcker took control of the Fed. He was blunt, direct, and unafraid to raise rates aggressively to fight inflation. Gold and silver reacted wildly during that period, some of the most turbulent years in market history. Not because Volcker was unpredictable, but because his policies forced a painful adjustment across the entire economy. Kevin Warsh is being compared to that era for a reason, not because he speaks the same way, but because the uncertainty he creates is producing similar shockwaves. Now look at more recent history. After the 2008 financial crisis, the Fed pumped enormous amounts of money into the economy. That easy money era pushed gold to record highs, year after year. Investors trusted one simple pattern: more money printed, more demand for gold. But that pattern only worked because the Fed's direction was predictable. Under Kevin Warsh, that predictability has disappeared. And when predictability disappears, something else takes its place: fear, caution, and a rush toward safety. Here is something most casual investors are not watching closely enough. Central banks, real government institutions, not everyday traders, have been buying gold at a record pace, not for a few months, but consistently, year after year. This is not a reaction to Kevin Warsh specifically. It is a much larger trend, tied to growing concerns about how much the world depends on the US dollar. Many countries are quietly trying to reduce that dependence, and gold is their preferred tool for doing it. So while everyday traders react to Warsh's every word, swinging prices up and down in the short term, central banks are playing a completely different game, a slower, steadier, long-term game. Now add silver into the picture, because silver tells its own unique story. Unlike gold, silver is not just a safe haven metal. It is also an industrial metal, used heavily in electronics, solar panels, and new technology. That means silver demand comes from two very different directions at once: investors seeking safety, and industries needing the physical metal to build real products. When both of those demands rise at the same time, silver can move even faster than gold. This explains why silver has shown some of the sharpest swings during this entire Kevin Warsh story, moving harder and faster than gold in both directions. Here is the deeper pattern connecting all of this together. Gold and silver do not simply respond to interest rates on their own. They respond most directly to something called real interest rates. This means the interest rate left over. After accounting for inflation, when Kevin Warsh sounded tough and hawkish early in his term, real rates rose and gold fell. When he softened his tone in Europe, real rates eased and gold jumped back up almost immediately. Every single swing in this story, every headline, every price jump, traces back to this same simple relationship. Understanding this changes how an investor should read the news. It is not really about whether Kevin Warsh sounds tough or soft in any single speech. It is about what that tone does to real interest rates, and what those real interest rates then do to gold and silver. That is the actual mechanism driving this entire story. Not emotion, not headlines, but a direct, measurable relationship playing out again and again. So where does this leave things heading forward? The historical pattern is clear. Uncertainty at the top of the Federal Reserve, combined with a massive money supply that cannot easily shrink, combined with steady central bank buying in the background, all of it points toward the same underlying condition: sustained, structural demand for gold and silver, not because of any single prediction, but because of forces far larger than one man's words. While ordinary investors are still trying to make sense of yesterday's headline, something else is happening in the background. Large institutions, hedge funds, sovereign wealth funds, pension managers, they are not waiting for clarity. They are positioning right now, quietly, before the next major announcement even arrives. This is the part of the story most people never see, because it does not happen on the news. It happens in trading rooms, spreadsheets, and quiet phone calls between fund managers. Here is how it works. Big institutions do not wait for certainty, because by the time certainty arrives, the profit opportunity is already gone. Instead, they study patterns, they study behavior, and they position themselves ahead of the crowd. Right now, the pattern they are watching is Kevin Warsh himself, a chairman who has already surprised the market twice in 2 months, once with a tough, silent first meeting, once with a softer tone weeks later in Europe. Institutions understand something simple. If a Fed chairman keeps surprising the market, the smart move is to prepare for surprises, not for certainty. That is exactly why gold and silver have both seen unusual buying activity, even during weeks when the headlines seemed calm on the surface. Now here is something worth addressing directly. Mainstream financial media has largely treated this story as routine, Just another Fed chairman settling into a new role, just another cycle of speeches and meetings. But that framing misses something important. This is not routine personnel change. This is a structural shift in how the most powerful financial institution in the world communicates with the public. A chairman refusing to share his own rate forecast for the first time in 14 years is not a small detail. It is a signal that the era of predictable hand-holding Fed communication may be ending, and markets that grew comfortable, even lazy, over the last decade are now being forced to relearn how to read uncertainty all over again. So what exactly are the warning signs institutions are tracking closely right now? The first is currency stress. When trust in a currency weakens, even slightly, it often shows up first in how aggressively countries buy gold as protection. That buying has already been happening, at a record pace, quietly, in the background of every headline about Kevin Warsh. The second is bond market behavior. Bonds and gold often move in relation to each other, and unusual movement in bond yields, especially real yields, tends to arrive before big moves in precious metals, not after. The third, and perhaps the most telling, is the metals price action itself. Sharp, fast moves, followed by unusually strong recoveries, often suggest that big money is stepping in during moments of fear, buying while smaller investors are still selling out of panic. All three of these signals have been visible, clearly, throughout this entire Kevin Warsh story so far. Here is something most casual investors overlook completely. The gap between what insiders understand and what the public reacts to is often where the real opportunity lives. By the time a headline explains what happened, the institutions already positioned themselves days, sometimes weeks, earlier. This does not mean an ordinary investor cannot benefit from this story. It means the value is not in reacting to yesterday's headline. It is in understanding the pattern underneath all of the headlines combined. This is exactly why the volatility connected to Kevin Warsh should not be seen as random noise. It is a signal that something larger is unfolding beneath the surface of daily price swings, a signal that institutions are already responding to long before most retail investors even notice a shift has occurred. So the real question becomes not what happened yesterday, but what comes next. What happens when the next major Fed meeting arrives, and Kevin Warsh is forced once again to choose between sounding tough or sounding soft. Every story eventually arrives at the same place, the moment where information has to turn into a decision. Everything covered so far, the violent nomination day reaction, the historic silence at his first meeting, the softer tone in Europe, the record central bank buying, the institutions quietly positioning in the background. All of it leads here. To the question that actually matters: what does this mean for someone building a business, managing capital, or simply trying to protect what they have already worked to build? Start with the plain truth. Nobody can predict with certainty which version of Kevin Warsh shows up next. The tough, silent chairman from his first meeting, or the softer, measured voice from that stage in Europe. Both versions are real. Both have already happened, within weeks of each other. And that is precisely the point. The uncertainty is not a temporary problem waiting to be solved. It is the environment itself. Anyone waiting for clarity before making a decision may end up waiting far longer than expected. For business owners and entrepreneurs specifically, this story carries a very practical weight. Every business holds cash, reserves, working capital, and every one of those dollars is exposed to the same uncertainty running through this entire story. When a currency's value becomes harder to predict, smart operators do not panic, they diversify. This is not about abandoning cash or currency entirely. It is about recognizing that placing all trust in one single asset during a period of genuine monetary uncertainty carries real risk. Gold and silver, throughout history, have served one consistent purpose during periods like this, not as a bet on prices rising quickly, but as protection against not knowing what happens next. Think carefully about the range of outcomes still sitting ahead. If Kevin Warsh leans hawkish again, raising rates, tightening conditions, gold and silver may face renewed short-term pressure, similar to the worst quarter decline seen earlier this year. If he leans dovish instead, softening further, easing concerns, both metals may extend the rally already underway. Most realistically, he continues doing both, shifting tone depending on incoming data, keeping markets reacting in both directions, exactly as he has done for the past 2 months already. Under all three scenarios, one thing remains constant: the long-term structural forces, a massive money supply, record central bank buying, a fiscal backdrop that limits how far tightening can truly go. None of these forces disappear, regardless of which version of Warsh speaks next. This is where the deeper lesson of this entire story becomes clear. Precious metals were never meant to be a bet on correctly predicting a single speech or a single meeting. They exist as a hedge against the very condition this story has documented from beginning to end: genuine, sustained uncertainty at the highest levels of monetary policy, a business owner does not need to correctly guess the next Fed decision. They need only recognize that the size and speed of these swings, already proven through real price action, make preparation more valuable than prediction. There is also a broader lesson here about patience. Markets reacting emotionally to every headline, every phrase, every data release, often lose sight of the larger structural picture unfolding underneath. Central banks, the institutions with the longest time horizons and the deepest understanding of currency risk, have shown exactly how to respond to this kind of environment. They have kept buying, steadily, consistently, unmoved by short-term noise. That is not a coincidence. It is a strategy, one built for exactly the kind of uncertainty this story has laid out in full. As the calendar moves toward the next major Fed meeting, and eventually toward September, the same underlying questions remain unresolved. Which version of Kevin Warsh will show up? How far will real interest rates move? And how will gold and silver respond once again? Nobody can answer those questions with full confidence today. But understanding the pattern, the history, the mechanics, and the institutional behavior sitting underneath every headline puts any serious observer in a far stronger position than reacting to the news alone. This is not a story with a clean ending. It is a story still unfolding, one meeting, one speech, one data release at a time. And for anyone serious about protecting capital, building a business, or simply understanding the world their money moves through, that unfolding story is exactly the one worth watching closely as it continues into the months ahead.